Welcome to another episode of the Knowledge Box with BFA and Co Legal. I am Chukwuebuka Atusiuba, an associate of BFA and Co Legal, and with me is
Favour, Kalu, Whyte, and I head the Private Equity, Startup and Technology Department here at BFA and Co Legal.
In our previous episode, we discussed how businesses go from their pre-seed stage to creating their MVP to a point where they are able to make money. Today, we will be asking the question and trying to answer whether safes are still safe, right? Now, when you think about a company, the whole idea of a company is that they're a company that runs with money and creates business so that they can also make money. Now, what makes that possible is funding. And so, Favour, can you please explain to us what funding is to a business, as well as the importance of funding for a business venture?
Thank you, Chukwuebuka, and it's nice to be back here on the show. Very catchy topic, by the way. So funding, right, which can be interchanged with financing in the commercial sense, is basically the injection of capital into a business, right? So what do I mean? For you to start your business, like I like to say, for you to make money, you have to spend money. Yeah. So how does the money even come in the first place? You understand? Yeah. Yes. So in the whole commercial sense, right, it's financing. You have to finance your business to be able to be profitable. Okay,
so if you're thinking about like a sole proprietor, you'll be thinking about him bootstrapping
to
make money.
That is him financing.
Yes, so but when you're thinking about like a company or a small business that has to have more money than a normal sole proprietor, then you'll be thinking about different ways in which you can create that funding.
Exactly.
Except from that is not from your own purse.
Awesome, exactly. Okay. And you see that in the commercial sense, right, there are types of financing. So there's a debt financing, there's a equity financing, and my own type of financing is a hybrid. So in the hybrid system, right, you have a mix of both the debt and the equity financing together. So
when you talk about debt financing, what really is debt financing? Because I know debt is like a loan, right? So when you're collecting that, does that mean that you are collecting loan for an interest? So what does that really mean when you talk about debt in relation to funding finance?
Okay, so in the context of commerce, right, debt financing is you actually taking on a loan, right, for your business. So thinking about business loans, right, not the one you take from Lapo Finance or this microfinance bank. So it's actually a business loan, right, for your business. So you're financing your business by taking on loans, credit, basically. So you can think of peer-to-peer loans, business-to-business loans, right? Actual bank loans, you understand? Those kind of things. So that's just if for debt. As the name goes, you're taking on a debt, right? And the connection that you have, the obligation you have in that situation is that you're paying back the principal and the interest.
So for the founder, his obligation in relation to this debt is that he has the job of giving back money that he has collected from the financier, who is known as an investor. And then for an investor, his work is his own part is to ensure that this money is given back to him.
So they're not really investors in the sense of it, right? So because you have to look at the relationship. If I'm giving you money, right, a credit, and I'm expecting my principal back and my interest, right, it's a loan.
It's a loan, it's not an investment.
It's not an investment. So that's also one thing that I have come to see in transactions that I've worked on. There's a thin line between investment and loans, right? And when I say investment, it's the regular, oh, I'm investing in you and I'm trying to get my return on investment, right? There's a thin line between that because I invest a capital sum, a principal sum, and I'm expecting my principal sum back and also expecting interest, whether or not that business becomes profitable. So there's a thin line there, and sometimes, right, that line is blurred. Exactly. So if that is the transaction, if that is the relationship, right, that is a glorified loan.
Okay. So when you talk about somebody who lends money to the founder, you can call him a creditor.
Exactly.
So what that means is at the end of the day, if the business goes down or the statistics of business going down is really high, and then if that business goes down, he's entitled to getting the creditor is entitled to get the money back. And that would be different from if he was an equity investor, right?
Yes, so equity financing basically is injecting capital in exchange for equity. Now, equity, like I mentioned before, is your ownership stake in the company, right? So if I inject capital, right, for a particular amount of equity for shares, right? That is different from a debt financing. In that kind of situation, and that is a true investment, because in that kind of situation, whether or not, so the profitability of the company determines my own return.
Okay.
Because now I am part of the company. Dividends are shared, right? I am part of the company. If the company doesn't become profitable, I don't get anything. So that is a true investment.
So let's take it one after the other. So when it comes to equity financing, right, it means that, first of all, your money is not going back to you. And so it means that I'm putting in that money with the expectation that when the company starts making profit, start making money, then I will start getting a return on my investment. Okay?
So one funny thing is that, so I wouldn't call it funny. I think that we have stretched the bounds of what investments would be. And I'm fine with that, right? I mean, it's a commerce. It's commerce, it's the commercial world, right? Before the rise of startups and the very heavy risk investment in startups, right? They were the, I buy shares in a company, which was actually kind of like equity financing. So I buy shares in a company, right? And the idea being that, at some later time, the value of that share will appreciate and I would get dividends too. So apart from actually owning shares in the company, right? I would also get dividends where the directors say, this has been a profitable financial year. However, now we have shifted from that to being that, I own shares in the company, but I'm just holding the stake to when that business becomes profitable, because in turn, the value of my shares will now increase. Exactly.
Okay. What will you now say is the method in which people are able to invest via equity?
So they're very popular methods, right? So, and I'm looking at this via the investor way and the founder way. The very popular one, venture capitalists, their sole purpose, their sole objective is to invest in high risk, high yield returns, right? So they are professionals in the investment.
It's like gamblers.
actually, investment is gambling, right? Because you're taking like a high risk and betting on this company. And sometimes, they spread their risk and then they're like, they are gambling on so many companies, right? And then we think about the private equity firms. So private equity firms, you'd see there are a couple of high net worth individuals or people that just come in and they pull some together and then do like a trust fund and they just invest, right? And then we look at angel investors. Angel investors are people that are investing as individuals, right? High net worth individuals, they're investing at that. Even family, friends can invest. But they're investing for equity, or they want like an owner, in exchange, they want an ownership stake in your company.
Very recently, Sir Jim Ratcliffe bought a stake in Manchester United, right? And he bought 25% of the club.
Okay.
And so what he did was that he got shares at a premium. So what kind of financing will you say that is?
Okay, do you know how much the shares were going for?
So at the point where he bought it, the shares were going for around 22 to 25 pounds.
On the public market?
On the public market, okay. And then he bought it at 33 pounds per share.
Okay, so definitely a premium. Definitely a premium. Now, it depends on who exactly he bought from.
He bought from the stakeholders who bought their shares from the public trading.
Okay, so he bought from existing shareholders.
Yes.
Right. So in that kind of situation, right, it's tricky, right? The reason why I would buy shares in a company, right, is just like we said, it's a risk, it's a gamble. I want the value of these shares to increase so that I can in turn sell it to a third party, sell it to the company, and get a profit on that share. You understand? So if he bought it from the private individuals, like the current shareholders in the company. He bought it from them, right? I wouldn't exactly call it an equity financing. I would just call it like a normal transaction, normal business transaction. Somebody made money off selling off their shares. Now, if the company had listed their shares on the floor of the stock market, right? Or if they had actually called out to the public to say, hey, you know what? We've increased our shareholding, we're issuing our shares. Something like what MTN did. Right? Yes, if they come and say, oh, you know what, we want to raise money. It's not really raising money. We've increased our shares, and this is how much they're going for. Ordinarily, this is how much they're going for, but if you buy, at a premium, now that is equity financing because the money is going to the company. It's going to in exchange for shares in the company. Now, remember, a company is a separate entity from its shareholders, right? Even though it is run by the directors and the shareholders, exactly. But if the company now says, so you know what, we're increasing our shareholding, we dilute the existing one, but we're increasing our shareholding, and we're listing it out on the floor of the market, right? Come and buy. That is equity financing, because they're collecting money in exchange for an ownership stake in the company.